2021 is almost over, and I'm getting questions about my forecast for the housing market in 2022. I usually knock out a housing market forecast in December or January, but I do have some assembled information that will illuminate my leanings in the forecast. There are several market forces that will impact home sales in 2022, so a simplistic evaluation of just one or two of them can be completely off. For example, how many so-called real estate experts called for the housing market to collapse in 2021? Do you think they'll be just rewiring those forecasts with an expected crash next year? Here's the thing about forecasts. They require a working knowledge of what consumers face when selling and buying homes. It's these pressure points that I'll share with you as I prepare my forecast for 2022. With the internet delivering so much information on housing these days, real, fake, and some mixed, it's easy to get overwhelmed by the fearmongers who want to scare you or the charlatans that want to trick you. Fortunately, there's a way to screen out both, and all you need to do when you hear a real estate news story is to ask yourself this question: how will that impact the supply and demand for homes? It really is that simple. Take what you hear with a grain of salt, and remember, with all market behavior, supply and demand is the dynamic that determines the direction of values. That's it. Last year, many were calling for a market crash because millions of foreclosures were going to swamp the market with inventory. When I heard that, my first thought was, how will that impact the supply and demand for homes? With the market at historically low levels of supply, I felt that, from a market standpoint, a few million foreclosures could help balance the market and stop runaway appreciation. And that's what I reported. The key is to take the news that you hear and apply it to the filter of all market knowledge. I have been saying for years that there is no new housing bubble forming. We're just not dealing with the same set of converging forces that we saw in 2006. So when you're watching videos about the housing market, ignore those that state a fact, whether real or imagined, and then show you why that singular issue is going to cause a housing market meltdown. In my preparation for a soon-to-be published U.S. housing market forecast for 2022, I've assembled 4 points that impact the supply and demand for homes at the national level and critique them based upon information that's available today. If you feel that I've left an important issue out of my video, please comment below so that I can be better prepared for my annual forecast. The U.S. population continues to grow, so we know we need more homes, more residential units being built and sold. It's not rocket science. People need shelter, so if the number of people grows, the number of shelter transactions must grow too. The size of the population is a primary reason why there are more home sales in an area like Tampa, Florida, with several million people, than there are in my market area, Tallahassee, Florida, with several 100,000 people. The U.S. is growing, though it appears as though the rate of growth is receding slightly. The continued growth of the population suggests that we will see continued growth of the housing market, though population growth in itself does not mean the market is immune to market corrections. While the overall growth of the population does impact housing, it is the demographic changes occurring that will have a stronger impact on home sales in the coming years. Perhaps the greatest demographic change is in the group of people most likely to buy a home. I was reading The State of the Nation's Housing, a publication by the Joint Center for Housing Studies of Harvard University, and I read that the changing of the guard from baby boomers to millennials will have a strong impact on the housing market now and for several years into the future. I've taken this quote from the report. Demographic changes favor home ownership. The Census Bureau's most recent population estimates point to strong growth in the number of 30 to 44-year-olds, the age group most likely to purchase homes. In addition, the economic fallout from the pandemic has had a relatively modest impact on higher income households, another demographic group likely to purchase homes. So from a population and demographic standpoint, we should expect this demand for housing to continue to rise as there are more people, and specifically more people in the home buying demographic with each coming year. Perhaps the most volatile factor that could impact the demand side of the housing market is in the future changes in mortgage interest rates. The demand side of the housing market has been heavily fueled by historic low mortgage interest rates. This graph plots more than 50 years worth of average monthly mortgage interest rates, and December 2020's 2.68% is the lowest of the 600 plus months plotted. If you closed on a home loan in December 2020, you should high-five your family members, because it appears as if you timed the market to perfection. The reason that mortgage interest rate change scares me so much is that at some point, rates are going to move higher, and it will have an immediate detrimental impact on home affordability. Currently, rates remain just slightly above record lows, but they eventually have to start moving higher. Will they move higher in 2022? 2023? 3 years from now? I have no idea, but they will move higher. When mortgage interest rates begin the inevitable move to higher ground, the pace at which the rates rise will determine the impact on the market. Recently, rates moved 0.25% higher over the past 2 months, a significant move, yet has not negatively impacted the market. In fact, it has caused many buyers to become stressed over a FOMO, fear of missing out. The pace at which mortgage interest rates rise, when they do begin to rise, will determine how much rates impact the market. If rates move slowly, rising less than 1% each year, there won't be an insurmountable sticker shock for buyers. Remember, as rates rise, home affordability declines. Even with small moves, I expect to see luxury home sales cool. Though I do not have a national statistic, I can share that among the top 1% of buyers in Tallahassee, based upon purchase price, 78% of them borrowed money when they purchased their luxury homes. This group of buyers will be squeezed quickly with rising rates. I am concerned about rising mortgage interest rates in 2022, and the pace that rates rise will directly relate to the pace of the economic recovery across the country. As I have said in previous reports, the Fed is somewhat trapped with competing interests on mortgage interest rates. The Fed will need to keep the funds rate low to help the overall economy. But at the same time, it's going to be concerned about runaway appreciation in the housing market. I suspect we'll see rates stay fairly low for the foreseeable future, and it's my belief that this will keep the housing market flush with capital for the rest of this year and 2022, if not longer. For most people buying a home, qualifying for a mortgage is a critical step in the home buying process. And a major component for this qualification is employment. According to the U.S. Bureau of Labor Statistics, the current unemployment rate has fallen again to 4.6% in October of 2021. This means the current rate is now below the 30-year average, but roughly 31% higher than the pre-pandemic rate of just 3.5%. We have to take in the full picture of unemployment. First of all, I truly feel for anybody who lost a job for any reason. Though I did not know it at the time, the pre-pandemic economy was one of the best ever when you consider how strong the employment rate was. That's why we are already below the 30-year average in less than 2 years of the pandemic's impact. Again, with respect to those who have lost jobs that have not yet been restored to full employment, the pandemic did not fairly distribute the losses, as the majority of remaining losses are for lower-wage jobs that are not a major component of the housing market. If you want a more in-depth study on lost jobs, I again encourage you to read the Harvard report. It does a far better job than I can do, explaining the impact of unemployment on the current and future housing markets. I have been hoping and begging builders to step up the pace of construction, both locally and nationally. Home builders have not kept up with population growth and has created a huge void in the housing market. This graph plots new construction home sales each year against the total population in the U.S. The number of new homes built and sold is shown in red and measured on the left vertical axis. Builders stepped up production in the past 2 years, but it was nowhere near the level required to fulfill demand. Even with heightened demand and historic low inventories, my estimate for 2021 suggests that builders only produced enough homes to record the 10th best year on record, despite the historically high need for new construction homes. Knowing that contractors build homes to earn their living, I am confident there has to be a reason why the pace of construction is so low. According to the National Association of Home Builders, the cost to build homes right now is through the roof, and while existing homes are moving up in value, they are doing so at a slower rate than at which building costs are currently rising. We'll have to take a wait-and-see position for builders to heavily return to the housing market. I do believe builder costs will not continue to rise as fast as will existing home prices, so I'm expecting new construction to gain momentum. Builders might have to pay close attention to the supply of distressed homes entering the market to ensure that we don't see the market flip to an oversupply at some price points. So we looked at 4 key factors, and you have to ask yourself, how will each impact the supply and demand for homes? And while we're asking questions, let me ask you to like this video and subscribe to the channel. It will help me promote the video, and your subscription will keep you informed when we post new videos. This graph plots the supply of homes for sale each month in blue, and then measures the relative supply in red. That's the months of supply. The red line shows clearly that the relative supply of homes for sale is at an all-time low. This is the reason that most markets are experiencing bidding wars on most properties priced below the top 15% of the market. This historically low level of inventory means that the market is nowhere near the condition it was in back in 2006 when demand began to fall. The supply of homes for sale back in 2006 and 2007 was approaching 4 million homes, whereas in October there were just over 1 million homes, which happens to be a decline of 23% when compared to October of 2020. This market is grossly undersupplied. That's why the red line has collapsed to a frightening level near 2 months of supply. This low inventory level exists because there are not enough new construction homes in the pipeline to alleviate the shortages in the market. I'll be so bold as to say that barring a huge run-up in mortgage interest rates, builders will not be able to bring balance to this market within the next few years. The problem, this lack of inventory, is one that has migrated from the for sale market now over to the for rent market, causing soaring rents and thus a start of home affordability crisis. I expect to see housing begin to dominate the economic media before the end of 2023. When we fully study demand in the housing market, we need to take a global look. Too often, I see reports that omit a major component of demand, and that means those reports can contain significant flaws when there are shifts in the market. So, how do we take a global view of demand? We don't just look at demand in the for sale market, we also have to look at demand in the for rent market. Why? Because each of these represent a demand for shelter. When shifts in the market occur, we often see homes and/or consumers move from one to the other. When rents drop, investors sell their for rent homes, thus reducing the supply in the rental pool while increasing the supply in the purchase pool. The opposite can be true when rents rise. Investors might purchase homes from the for sale market and then add them to the supply in the for rent market. So how do we go about evaluating each market? Finding data for the supply in the for rent market has been difficult, but a Zillow study of the average rental rates allows us to identify demand trends. If rental rates are rising slowly or even declining, we can conclude that the rental supply is rising. Conversely, if rates are going up at a fast rate, we can deduce that the rental supply is lower than the current demand. Today, when I couple the demand in the for sale market with the trend of rental rates, we get a confirmation of what I've been saying for years. Home builders are not producing enough homes to account for our growing population. Home prices are rising, and so too are rental rates, because there are more people seeking shelter than there are shelters to fulfill the need. When we look back over the past 8 years during the recovery from the housing bubble years, rents were still rising even as home prices were dropping, because there was a shift of consumers from the for sale market to the for rent market. The housing market was not truly oversupplied, rather many of the loan programs that were in place in the for sale market were terminated and the qualification standards for traditional loan products were tightened. This sent people from the for sale market to the for rent market, causing declining home prices but stable rents. This graph shows that the rate at which rents have risen in the past 8 years is about 4%, falling to a 1% rise when COVID struck and eviction moratoriums kicked in. But look at the change of rents this year. The red line shows an explosion in the year-over-year rent comparisons, and we've already have shown that home prices are soaring too. This is clearly a sign that demand is far outpacing supply. So without an injection of new residential units, we're going to continue to see both rents and prices move to toxic levels. We'll be hearing scary terms like rent control and additional government intervention in the housing market. My advice from past videos remains the same today. Evaluate your current living conditions and decide what you'd like to do and where you would like to live in the next 10 years. If you already are in that home, talk with a mortgage lender about refinancing terms. Even if your house is paid off, you might want to consider borrowing money before these historically low rates go away. In the coming inflationary period, you'll be able to invest that cash and do far better than the 3% interest you'll pay on your home loan. If you want a more expensive home, buy it now. Do whatever you can to get into that home that you know you'll want in the next 10 years, because it is very likely it will be out of your reach in the future unless you're cash strong. Home prices are exploding higher. Mortgage interest rates will soon follow. That's the double whammy for home ownership. When prices and rates rise at the same time, it makes your monthly payment go through the roof. Get while the getting's good. If you would like to see my video about the coming affordability crisis, you can view it by clicking on the box on the top left corner of your screen. To see my popular video featuring my top 6 home selling tips, just click on the box below it. Please remember to like this video, check out the links below it, and subscribe to our channel so that you never miss anything.